matters. We have, as you know, David provides through our partnership with the SBA monthly webinars on all things financial, utilizing the Money Smart curriculum created by FDIC. And so thank you, David, for tuning in. And with him this week, we usually try to have a subject matter expert just in case there are questions. And so we have two of our members of the chamber, Marvin Joe Esquire, attorney at law, and we have Jason Williams, CPA. So I think we got it all covered. We got the SBA, CPA, and an attorney. I think we can cover all bases. And with that said, I won't belabor this. David, thank you, and I'll hand it all over to you.
All right. So we're going to jump right in here. And Jason and Marva, whenever, I'm going to go through this slide, and the participants have their participant guide. It's been emailed to them. And so whenever I come across, in the presentation, we get to something that you want to add to, bring your expertise, just jump right in. We're not going to be terribly formal about this. Just jump right in and give us your thoughts on it. Okay, so let me begin by sharing my screen. I'm going to put it in slide mode. Here we go. And share screen, and here it is. Okay, great. So I'm starting with this third page of it. This is the objectives of what this is. Now, just a reminder for everybody, this Money Smart program was created by the FDIC and the SBA together to be a small business version of their general Money Smart financial literacy curriculum. It's available for free. You can get all these modules, and you can get the slides and the participant guides and everything about it on just by doing a Google search for FDIC Money Smart for Small Business. You get to the website where you can download these slides in their PDF format, and or rather the participant guides in PDF format, and the presentation is a PowerPoint. Now, these were intended to be done in person, right? In a small group setting, or 20 to 30 people, and everybody would have their guide, and you have the instructor up at the front, and we have an engaging conversation. It's not just a lecture. We've adapted it, and we're doing it online here, so we're gonna try to keep it engaging for you, and that's why we have the subject matter experts here as well. Now, please, do we have a Q&A set up? A Q&A section for people to put their questions if they have questions. Melissa?
Sorry, I was talking and I was on mute. That's up to you. Do you want them to put it in the chat, or do you want them to raise their hand, or you want to call for questions when?
Let's do the Q&A, so they can put their questions in the Q&A, and then we can go to them, and then Marva or Jason or I can go in there as we go along. Answer the questions.
Melissa and I will help keep track as well.
Cool. All right. Okay. So we're going to talk here about the organizational types, because some people in the audience, you may be at the very beginning and wondering what you should do. Our objective here is just for you to understand what a sole proprietorship is, a partnership, a limited liability company, a C corporation, and an S corporation. These are the most common types of business ownership organizations, entities. There's one other, which is a cooperative, but we're not going to discuss that here. That's a form of employee worker ownership. We're not going to discuss that one here. So,
David, can I just, I know I'm starting early.
No, go for it.
Not for discussion, but maybe just put a pin in it. If you would put not-for-profit organizations as also an option.
Okay.
For choices that may be available.
Now,
Don't have to discuss it, but I think that is also an option for some smaller groups.
It is an option. The only reason I haven't talked about it here, the reason it's not part of this, is because this is the SBA. all SBA programs are for for-profit businesses only. I don't know anything about nonprofits other than I worked in one before here, but I don't know anything about starting them, except from two degrees removed. I know it's just a big old thing to go get your 501c whatever, C1,
C3, yeah, or C6.
whichever
So I
kind of
just
nonprofit.
for the group, just put that on the side to know that there are some other things, not for this presentation.
Okay, and so, normally in the in-person thing, I'd ask some questions of the audience. What do you know or want to learn about organizational types for businesses? Can't do that here. So what are the 5 common organizational types? They're called legal structures. There's a sole proprietorship partnership. That means a general partnership, a limited partnership, an LLP. There's a limited liability company, SS LLC, a C corporation, and S corporation. Marvin Joe, can you give us a couple of sentences on the difference between a general, a limited, and an LLP?
Say again, I lost you.
Can you give us a few sentences on what's the difference, high level distinction between a general partnership, a limited partnership, and a limited liability partnership?
Yeah, a lot of times it deals with the liability. They're all pass-throughs, so it doesn't matter. Pass-throughs in terms of your tax requirements. General partnerships really put everybody on the same level in terms of management, in terms of structure and who has what kind of rights under the partnership. A lot of times you will find that those partnerships don't necessarily, depending on the way you write it, don't always pass someone dying or quitting. So there's some structural, but limited really talks about the management structure. And I'm glad you asked me about that one because I wanted to share one thing. And I had a client once who had a limited partnership. So there was a general partner, several limited. They did not protect their rights under their limited portion. And when it came time for distribution of money, because they hadn't gone to an attorney or someone could look at the contract, they got no money out of the limited partnership. So I think it's really important if you're a limited partner rather than a general partner that you understand what you can get or can't get. LLPs are typically with professional associations. So as a lawyer or an accountant, oftentimes you'll do a LLP, limited partnership, as opposed to general or limited. And but I don't even see those that many anymore.
So what would be the difference between an LLP and a limited? They both have the word limited in there.
They do, but the one, the LLP, the limited partnership, is typically saved for those professional organizations. Like I said, as an attorney, a lot of times those structures will do it as a limited partnership, or an accounting firm as a limited partnership, because a lot of times you cannot, as an attorney or as an accountant, you cannot create a legal structure with an entity outside of your profession. So I can have a limited, if I wanted to join as an attorney with an accountant, I would not be allowed to do so.
To do a limited one.
I could, no, I would have to do a LLP.
You would have to
And
do
it
an
could
LLP.
only, right, and it could only be with the same professional. So I could not even do a LLP between a lawyer and an accountant.
Okay. Somehow it's still not clear to me what's the difference between a limited and an LLP. They're both limited.
No, it's who's in it is what's the difference.
Okay.
That's what I'm saying. So you would not, if I'm an attorney, most times I would do a LLP. I wouldn't do a limited.
Okay.
So it's really the profession that is organizing it,
Right.
other than the structure itself. The structure is the same.
Right.
It's just who can be a part of it is different.
So LLP is for professionally
Lawyers, right?
lawyers, accountants,
right?
doctors
That have other professional licensing requirements that would prevent them from doing it with those outside of their profession.
And doctors, for example?
They would be a LLP. Yes.
Okay. What about engineers?
Hey, keep going. The experts now grilling the game.
Okay, yeah, if people down the line, we can do some
All right.
follow-up. But you
Okay.
typically, like I said, see them with lawyers and with accountants. Very
Okay.
stringent rules there.
So then we have the limited liability company, a C corporation, and an S corporation. All right. So factors for choosing an organizational type. All right. So this is what you're going to take into account here. Taxation. Taxes on profits are paid through personal tax returns, except for corporations. So the profits, you as the owner are going to get the profits, and you're going to pay taxes on the profits in your personal tax returns, except for corporations. Liability and risk. Responsibility for harm to another person or property or contract disputes, right? That is affected by what you choose for the organizational type. Management. Now, the decision-making authority. Who makes decisions in this thing? All right. Continuity and transferability. This is something that Marva referred to, how a business persists and how it is sold. Because a business is an entity that exists separate and apart from the human beings that are the owners of it. Right? In a lot of these organizational types, right? So in all but effectively one, the sole proprietorship. So if one of those owners leaves, sells out, dies, whatever, what is the continuity and how do you transfer their ownership to another person? Expense and formality. So it costs money to set these up, right? You're setting these up with the state under state laws, and there's legal responsibilities. There's a degree of complexity involved, right? So these are differences in there. All right. So which organizational factors, normally we discuss this, have everybody talking, have the most impact on your business? Which one? Is it the taxation? Is it the liability and risk? Is it the management? Is it the continuity and transferability? Or is it the expense and the formality? You want to consider which of them have the most impact on your business. That's going to lead you to choosing the right organizational type. Now, in a sole proprietorship, the business is one and the same as the owner. The owner is the business. That's it. Right? It's that simple. Now, very often people register some sort of trade name or doing business as. And how easy or hard is that to do in Maryland, Marva?
It's very easy as for a sole proprietorship.
All right. And if I want to do it alone, how much does it cost me?
Nothing.
Okay. All right. I was looking up the fees on setting up an LLC, and I was surprised at how relatively low it was.
LLCs are cost, but sole proprietor doesn't have the same formal requirements in the state of Maryland.
All right. Now, advantages and disadvantages of this are the owner has unlimited personal liability. This is always given first because, people are worried. Like if you were to actually start a business in a brick and mortar location and you're a sole proprietor and someone sues you for some reason, you have the personal responsibility. It's your personal wealth, your personal property that's at risk in any kind of lawsuit in this way. Now, the pass-through taxes, that means profits are taxed through your personal tax return. Now, the owner controls the business completely. So that's the management and the decision making. And it's the simplest form of organization. As you heard, it costs nothing to set it up. It's the lowest cost to form, nothing. And it's appropriate for a small startup. Oh, there's a little typo here. All right. Now, a general partnership is a business association of two or more people. Advantages and disadvantages are owners have personal liability. Let's say me and Marva start up a business, not a lawyer business, some other business. All right. We have personal liability for anything that somebody wants to sue us for. There is pass-through taxation. Right? The profits get distributed to us and we pay taxes on this through our personal tax returns. Now we are going to share risks and costs. It's pretty simple to form and it's low cost to do this. So we create a partnership agreement and that's it. We just get doing. We can register our trade name, our trademark and all that stuff, but we just get going, right? Like that. Now, the limited partnerships and limited liability partnerships, we talked about that already. We'll go now to actually the one that's most common for startups, and that is the limited liability company. Now, it's a hybrid entity, it's unincorporated, it has traits of a corporation and a general partnership, or even a sole proprietorship, right? So the traits of a corporation are that you have multiple owners, and each owner has a different interest in the business, a different, you might say, share of the business or percentage ownership of the business. You could have a single member LLC, which is how most startups get going. You have one member. There's greater flexibility than the sole proprietorship in distributing profits, right? And it's less restrictive than an S corporation. There's limited liability like a corporation. It's passed through taxation like a sole proprietorship or a partnership. The profits get distributed, and then you're going to pay for taxes on this. You pay taxes on that through your personal thing. Anything you want to add to that, Jason or Marva?
Yes, Jason here. Yeah, I would just add that for the LLC from a tax standpoint, and I know maybe you'll get to this later on in the presentation, but for tax purposes, you can eventually elect S corporation status for the LLC. Legally, it's still an LLC, but for tax purposes, you can become an S corporation. And there's some advantages and disadvantages to that, which I can probably talk a little more later on in the presentation about that when we probably talk about S corp.
Yeah.
But just to kind of bring that up.
And you
Now-
will have to, I'm sorry, you will have to make that election. So you can start the LLC and then make the election to go to a S corp. So.
Yeah, that's correct. Mhm.
And this detail to remember is that an LLC is something that you create with articles of organization at state level. S corporation is a federal tax filing designation,
Yes.
right? So you're still an LLC, but you're filing your tax returns as an S corporation. You choose that as opposed to something else. Right? You have a choice of doing it. Okay, so that's what that means. S corporation is in reference to the taxation, and that's a federal distinction made by the IRS for taxation. You're still an LLC. It's just that the way in which you file taxes changes. All right, corporation. That's just a legal entity created under the laws of a state. It's got its own privileges and liabilities, distinct from those of its members. It's like it's a fictional person. It's created under the law as a fictional thing, an entity. I shouldn't say person. It's got some of the rights of a person. Now, there's broadly speaking two types: C corporation, S corporation. Tell us what this slide makes you want to talk about, Marva.
Mostly that, since I suspect we're talking about small businesses, I would think most of the people here would, if they take the election, would do it on a S corporation. You can be a S corporation up into a certain number of employees. You find a C corporation is really, I think it's 100 and over, but it's larger corporations. And C corporation, they are taxed. They are taxed inside of the corporation. I think it's more complicated, and I would seldom suggest for a small business to be a C corporation.
Now, a C corporation, details here. It's also called a regular corporation. It's most common for big, large companies, right? So advantages and disadvantages are that it's limited liability, an advantage. The company is taxed, so double taxation is an issue. In that, for example, there's federal corporate income tax. You have personal income tax. There's federal corporate income. It's complex to form. You're gonna need a lawyer or maybe a couple of them to get this thing together. The ownership is complex. Right? It's what you think of in corporations. There's a president, possibly a CEO. There's a board. There's different shareholders owning, different percentages of the outstanding shares of the corporation. And it's appropriate for a few specific reasons, right? But otherwise, when you're starting out, you choose a different one. You don't want to get into anything this complex.
And I think you said, David, I just want to make sure that it survives the person.
Yes.
Because as you said, it's the entity that is in existence. So if someone dies, that would not cause them to have to get rid of the corporation.
Right. It's a legal entity that exists independent of the human beings that are the owners of the shares of the entity.
Yeah.
Now, S corporation. This has limited liability of a corporate shareholder. So for example, this is what this limited liability stuff. It means if I am a shareholder, if I own Apple shares in Apple Incorporated and Apple gets sued, I don't have to worry about it. I'm not going to get sued. Now, the value of my shares, because they are publicly traded on a stock exchange, the value of my shares might go down. The value being the price at which someone will buy my shares, right? The price I can get when I go sell it. The value of my shares can go down, but I'm not going to get sued. It just means that if the company gets sued and it's something very negative and its reputation falls and it affects its profitability, the value of my shares might go down. But that's it. I don't get sued. So in an S corporation, there's the limited liability. I don't have any liability in this sense of a shareholder, but you pay income tax like a sole proprietor or a partner. So it's the same. The advantages and disadvantages are the same as a C corporation, except for this pass-through taxation, right? If I'm a partner in this S corporation or an owner, a part owner of this S corporation. Now, Jason, what can you tell us about pass-through? Can you give us a succinct explanation of what this is really getting at?
Well, yeah, pass-through basically means that all the income that the company earns, the business earns, passes through the owner of the business, and you pay taxes on those income on your personal return. So basically, that's what a pass-through is. And as you say, C corporation, partnership, single member LLCs, they're all pass-through entities. So the corporation, for example, the S corporation actually files its own tax return, but this is an informational return. So it's called an 1120S. So the S corp files that, but then the owner of the business gets what is called a K1, and on that K1 is the income from the S corp, and then the owner will use that to file their personal taxes and pay taxes on that income. So in a nutshell, that's what it's meant by a pass-through, it being a pass-through entity.
So let's consider a good analogy for this. I took the pens and ruler and erasers and the markers out of this. This is what I have where I keep my pens, right? It's a little mesh. Think of a pass-through entity as being this container. This container. It's got mesh. You can see through it, right? Money comes in from the sales. You subtract all the expenses and the costs. Out of it comes the profits. The profits pass through and they come to me, the owner, as income. And I pay taxes on that income. The money comes in, it passes through, comes out to me as my income as an owner. Let's say I'm one of the two owners of an S corporation. So me and the other person, right? Well, let's say it's the three of us, Jason, Marva, and me. It passes through the entity. It comes to Jason. He gets his distribution. I get my distribution, 1/3, Jason 1/3, Marva Joe gets 1/3. Money passes through the entity, comes to us, and we pay taxes on it.
Yeah.
Okay. So now, how do you choose? How do I decide which one is better for my businesses? Now, here it gives you this very traditional approach. Establish a business plan, think about the business. What are initial guidelines? Am I an owner operator? Am I actually doing the work of the business? Is it a partnership? Do I have multiple owners? Do I have a product with significant liability? Right? Do I have the kind of product in which being sued for something the product does or fails to do or causes is a possibility? Is it a large venture here with a lot of owners and very complex financing from a lot of different sources? All right. It says you should ask an attorney. It says you should do research through the Small Business Administration and IRS websites. But we are here to tell you it's actually not that complicated. From Marva's laughing. It's actually not that complicated. In the beginning, right? This is what we're going to discuss here. In the beginning, you are just getting started, and what you need is something that serves a few purposes, and it's not written explicitly in any of this here. You need something that allows you to go out and get and protect yourself as far as liability, just in case, and get yourself a business banking relationship with someone, and keep track of whatever money it's making separately from your personal money. A lot of people get started with a business and they're not working full-time in the business they started. They have a full-time job or a part-time job that's another source of income while they get this business established and running and operating and making some money. So you want to keep the business's cash flow separate from your personal cash flow, from your salary or wages or whatever you're earning from your other business, from wherever you're employed, or maybe you're an independent contractor getting employed somehow. You want to keep this new entity's money separate and distinct. So that's really why you want to get to something. Right? That's what you really want to consider here. Right? Marvin, Joe, Jason, what do you think about that?
Well, that's typically when we're advising businesses, that's really, it's like, accounting one business formation 101. You want to separate your personal from your business, all your income and so on. And for several reasons. First of all, if you're not separating the two of them, then you're going to have issues basically running your business and understanding how your business is performing. And then it creates problems when it comes to filing your taxes, what's for the business, what's for your personal. And there's also something where the IRS can also, if you're commingling your business and your personal expenses and so on, the IRS might also look at that and say, you're basically not running a business here because the two things are combined into one, and you might not benefit from certain deductions you might have gotten as a business. So it's very important to separate the two and, keep your personal separate from your business. Every startup, whatever stage you are in the business, if you're up and running and you're not doing that, that's something you need to do like, yesterday.
I
So
wanted
that's
to
my,
add, oh, I'm sorry.
go ahead, Marvin.
No, I was gonna add, as part of the separation, you're gonna be taking expenses on your taxes. So you want to make sure that those are clearly demarcated.
Mhm.
And one of the ways to do that is having that separation. And I find that sometimes people don't make that separation. Other thing, you have to be really careful when sole proprietorship is so informal. A lot of places you do not even have to file for it. But once you become a entity like a LLC, there are things like property taxes, a property return that you would have to do because you're a formal entity. And one of the things that I have seen is that people who have not certain types of businesses, but who have businesses and don't do those things that are required as part of their formality, and then they are not in good standing. And half the time do not know that they're not in good standing, or they forfeit the business. Or I've seen people who weren't, and then somebody comes in and takes their trade name, that kind of stuff. So once you formalize it, make sure you understand all of the requirements of the state and federal as it relates to that formalization.
Yeah. Now, I have a story for a little bit later about a local business here that I really like, and I hope they do resolve their problems regarding trade names. Now, tell me a little bit about trade names and how easy or difficult it is, and what exactly is the difference between a trade name, a trademark, a copyright, that sort of thing. Marvin, Joe?
I'm just going to do, marking, the trademark is a lot more. So let's just start with I don't want to get that complicated because I'm sure they'll have questions. But a trade name, you can go on the state's website. They have a list of names that are allowed. Before you pick your name, you want to make sure that it has not been taken. Ken and I just had to deal with this for something else. but it's not taken, you reserve it, wanting to make sure it's not so close. Cause if you are a corporation, you're Inc., if you're LLC, but really it's just going on the state's website, SDAT, and looking and see, and then get yours when you do your, if it's a LLC, your articles of organization, or articles of incorporation if you're doing one of the C or S. So it's really, really easy.
Okay. And the
The
trade
other
name,
ones, I think, well, down the line, because they're more technical in nature.
and so the trade name is just the name I'm going to give to the business, to the LLC. If I'm gonna be starting a tax preparation, tax return preparation services. Let's say I'm an enrolled agent and I'm going to call it Speedy Taxes. That's my trade name, and I got to go register that trade name as long as somebody else doesn't have it, right? Is that what we're talking about here?
That's right. And you want to make sure, because it could be a big problem. Well, they're not going to allow you to form it if it's there, but you want to do your research early in that process.
So you'll be able to form your LLC, but you may not be able to get this trade name, and that's what you want to be,
That's what I'm
prepared.
saying. Before you do it, make
Yes,
sure
sir.
you know what you can do prior to, not after.
Right. Okay. Now, it says here that a business plan is the best way to determine the organizational structure that's right for your business. That's sort of complicated. It's not like you're going to write a business plan and say, oh, wow, I should do a C corporation. No, that's not really going to happen. That's not realistic. Realistically, it's the factors that are involved are those ones that I listed, that Marva has mentioned. Is there anything else in choosing the business entity type that people should consider, perhaps from a CPA's point of view? Jason?
Well, I mean, you want to think about, the income that's going to be generated and your personal situation in terms of your taxes and so on, and how that might impact, because different structures have, some of them are passed through the C corporation, which I obviously would recommend for small businesses. But if you think of, like, for example, are you going to take a salary from the business, that's a requirement for an S corporation. If you weren't planning to take that salary, for example, then you couldn't do the S corp status because IRS requires that you pay yourself a reasonable salary. So the whole financial, you have to look at both the business and also your personal situation and how that impact you. Is it going to be one person or several persons in the business? So you got to look at all of these things, in addition to what you mentioned before in terms of deciding which type of structure you'd like to use for that business.
Now, if I form an LLC, I'm going to be paying myself. Let's say I form a single member LLC, and I'll be what they call distributions of the leftover money of the profits. But can the LLC hire me as a W-2 employee and pay me a salary or wages instead?
Well, no, for the LLC, no, typical LLC member doesn't hire themselves as a W-2 employee. Yeah, because you got to be the thing with the LLC, you are required to pay self-employment taxes, so you can't do that. And self-employment taxes, this is the employer part of it that you would pay as a W-2 employee. So by hiring yourself, you would basically be foregoing some of that self-employment taxes. So even if you do that, I mean, structurally you can do it, but you would still have to pay the employer portion of that self-employment taxes on your individual tax returns. So even if you did do it, it really wouldn't help you from a tax perspective, really. Because you, as a single member LLC, you're both the employee and the employer. So the IRS says you got to pay both taxes. And that self-employment taxes, it's like 15% basically of your gross income. So it can be done, I think, legally. There's nothing that stops it, but there's no benefit to doing it then. You only take on an additional administrative burden that you have to do and run a payroll. So it's something I wouldn't recommend for a single member LLC.
Okay.
I did one, I don't know if this is a legal or accountant, but I think you look very seriously at what you want to be your expenses and understand what implication those businesses. For example, if I'm a single member LLC and I want to do a 401k, or if I want to do some kind of savings plans, and be able to talk to that accountant about the implications of the expenses and where you place those expenses for purposes of your tax returns, because it's a pass through. And I have seen people who are very adept at knowing how to not create expenses, but how they show their expenses with respect to the LLC. Because you also are trying to limit or minimize your tax liability.
Yeah. And that's a very good point. If I might jump in here, Marva, you mentioned the 401k. That's something we typically recommend for, most persons with, a pass-through entity, a single member LLC. And that's one of the tax planning tools we use a lot, because it's much more generous, contributing to the 401k, solo 401k, but you would get as an employee. For example, you can contribute up to like 65,000 depending on your age, to your solo 401k. And all of that goes to reducing your income and your taxes. So that's a very good tax planning tool. So yeah, good you mentioned that, Marva. Yeah,
Yeah, pre-tax, post-tax, and how it shows. on the
exactly.
books. Yeah, and it can, if you don't need it, put it for later.
Yeah. Mhm.
All right. Okay. So I bring it up just because sometimes I've noticed that in some businesses, the owners will pay themselves as a W-2 employee. But that is
Yeah.
not a question of needing to or being required to, but they do it for a different reason, which is a way of enforcing discipline about how much of the profits they take out of the business.
Yes.
And that has less to do, that is something that is done with an eye towards future financing needs when you're seeking outside financing. Because if you don't do that, and if you just pay yourself through the distributions and you take every possible deduction, what's going to happen to the profits, Jason?
Well, yeah. So let's look at profits and distribution, and it's the way your bank look at it. So if we look at your actual profits and then maybe your cash profits, which is what I think you might be referring more to, because the distributions come after your profits, really. So, let's say you make 100,000 in profits. That's your profits. Now you may or may not take a distribution. But as you mentioned, if you're taking out 100,000 for your distribution, that basically leaves you with cash flow of zero, in a hypothetical situation. So you go to the bank to borrow and they look at, your profits, 100,000, but you basically take out 100,000 as well. So there's nothing left to pay the bank, so the bank is going to say, well, you need 100,000 for your living expenses. So what you're describing there, doing the W2 and maintaining that, discipline. So let's say the same situation, profit is 100,000, but you're only paying yourself 50,000. So you're leaving that 50,000 in the business, assuming you're not taking a distribution. So it's separating your paper profits from your cash flows. It's a distinction there. So if you're taking out all the cash, then there's nothing really left to service a loan, for example, if you're going to look for credit. So that's how I look at that situation.
Yes,
there.
exactly. That's what I was getting. I've
And I
seen.
did, I'm sorry, I did
Go for
want
it,
to
go for
add one thing, because you brought up W-2, but also we know we have the option W-2 employee or consultant doing the 1099.
1099, yeah.
So know the implications of what you would have to pay if you were paying a W-2 employee versus the implications, financial implications, if you're just hiring a contractor consultant and paying them as a 1099. And that too will have some impact on your bottom line.
So I have the LLC, let's say I start this company and I can pay myself, right, money from the business, which is money I'm gonna use to, I don't know, pay my rent, pay my mortgage, pay my car, note, pay, whatever, right? There's three different ways. I can hire myself in the LLC as as a consultant or contractor. I can pay myself as a W-2 employee, or I could just do neither of those and take a distribution of profits. Right. So those are the three ways I, as the owner, am going to receive income from this business. And each of those is a tax implication, right? And each of those has a long-term, or let's say medium-term, not long-term, a medium-term implication for what you might want to do in the future 2 or 3 years from now in seeking outside financing, right? So this little webinar is about organizational types, but what we realize, what the three of us are saying or getting at here, I think, is that really what you're going to do is you're going to do an LLC. It's low cost, it's limited liability, it's pretty simple to manage. It's not the simplest administratively managed. It's not the simplest as sole proprietorship, but that has so many negative things attached to it that you don't want to do that. So you do an LLC. And now that we know the best thing to do as an LLC is then remember there are these tax implications. Talk to Jason, talk to Amarva, right? And figure this all out for yourself. And keep in mind that you are attempting to do two things. You are attempting to pay yourself reasonably well, but you are also attempting to show for the next 2 or 3 or 4 years that the business makes a profit. Because 2 or 3 or 4 years from now, when you go to Banker Ken, because he used to be a banker, so I was using this example, and you try to look for a loan, Banker Ken is going to want to know, are you profitable? Right? And in the example Jason gave, if there was $100,000 in profits and you took it all and left nothing there for the business, then that's not going to look that profitable. Right?
But you know, it's interesting that you say that, David, and we deal with this all the time because they are working at cross purposes. On one hand, as an LLC or sole proprietor, I want to look like I make no money because I want to limit my tax liability.
Exactly.
But when you try to do that, so you're not paying the IRS goo gobs of money, to your point, when a banker, and Ken and I've had this conversation, to a banker, you look depleted. Yes. And so trying to find that balance between tax liability and business viability can be a very hard balance to do. But I think you should spend the time to make sure if you have some needs on the banking side that you don't deplete yourself so much that you can't be viable for getting loans or lines of credit.
Yes. So can you guys hear me?
Yes.
Yeah. So I have a phrase I coined many years ago, and I say that you want to talk to your accountant and you want to talk to your attorney and you want to have a conversation with them and say, I want to minimize my tax liability, but maximize my growth potential. And this is leading to something that sounds it sounds a bit Puritan. It sounds a bit Puritan Protestant work ethic kind of thing. The reality is, of all the business owners that I've met in the last 10 years that I've been involved in work like this, before the SBA and now at the SBA, who, you know, people I meet in their first 10 years of business, the first couple of years, they're not making any money from it. Meaning they're not taking any money from it. The business might be profitable, but they leave it in there. They might have another source of income from a part-time job or a full-time job, but they're not using any of the money that the profits the business is making. They're leaving that in there to show that the business is profitable as it grows, so that when they go seek outside financing, they can say, for the past 3 or 4 years, this business, you can see profits have been increasing, sales have been increasing, et cetera, and so on like that. And whatever salary they had, whatever they were doing, that's what they're living on. And then even when they switch over, they live on as little as they can get away with, right? They live on, you know, like, let me meet my requirements. I got a car note, maybe I got a mortgage, I got food. If they got a family, well, you got expenses in there. If you got a partner, you're sharing those expenses, okay. But minimal. You do not go out and buy your dream car yet. You do not go and spend profits on this. You're leaving it in the business, because that's how you're going to show that there's growth potential.
in the long term. All right, so this is this is I think the shortest module in this series. And we come to the end of it here. And what I want to get to is now questions. What final questions you might have regarding this? So is that in the, oh no, there's a meeting chat, not a Q&A.
David, I'm sorry.
Jump in.
I didn't realize we were on the end. And I know we talked a little bit about transferability, but I just wanted to say one other thing. You know, we said corporate is an entity unto itself. And so once something happens, be it divorce, be it death, be it anything, that doesn't affect the corporation, the corpus of the corporation. So you do have to be sensitive when you're doing partnerships, because sometimes, you know, divorce and other things, and being real clear about the transferability if somebody dies, and to make sure you address those issues if you can in the organizational documents. And sometimes people, you know, don't think about it in terms of what happens if I'm not here to this partnership or this limited partnership or whatever. So just make sure you think about it in terms of succession and transferability.
In the articles of organization is what you're talking about, right? Put it in there, like what's going to happen. And in these articles of organization, you're also gonna spell out who does what, how decisions are made, who can make decisions.
Yes.
All of this is in there, and you have to be very, very dispassionate when you're doing this. Like, especially if you're doing this with someone else. If it's you and someone else, and you're doing
articles or your partnership documents.
Yes.
But make sure that you address it, because I always say it's fine until it isn't. And
Right.
so,
Yeah, I grew up with my best friend. We've known each other since preschool, and we're going to start a business together. And then all of a sudden something happens, and people can get very weird when it comes to ownership, money, profit. I mean, it can bring out the best in people. It can bring out the worst in people. And if you don't have it spelled out in your articles of organization or in your partnership agreement, then well, not a criticism of Marvin Joe's chosen vocation, but then you're going to have a lot of lawyers arguing with each other. You're going to be suing each other, and you don't want to do that. So avoid those problems by doing it early, doing it first in the articles of organization, in the partnership agreement. Anticipate different things.
And one thing, because I saw a question, and I probably they asked about in the chat, but these are contracts, right? So you can contract yourself into anything.
Yep.
And so you want to contract it in such a way that any question you have can be answered in the four walls, if possible, of whatever that agreement is. I typically with clients will say to them, I'll have different kinds of checklists, just to get them to start thinking about. And, you know, Jason was talking about David. It's the organization, it's what's the liability, but it's the tax consequences, it's the transferability. And those checklists really force you to answer all of those questions before you start. That's not a business plan, but I think it's as important, if not more important, when you're deciding what kind of structure you want.
So Marvin, you guys just gave me an idea. So we're going to need to develop a webinar on partnership agreements, bylaws, and operating agreements.
Yeah, because it's a lot. And one of the things I will say that I also find, whether it's a small business or it's a nonprofit, we are good at what we do. What I mean by that, whatever you're chosen. So if you are a insurance agent, or if you are whatever you choose, where I find most of the problems is the back office, right? They're good at what they do, but they don't take care of those things like the accounting, the legal, and all of that, because a lot of times they don't have time and they don't focus on it. And so if you do that at the beginning, it will serve you well as you move forward in your business.
Yeah.
So David, we do have some questions in the chat. So
Yeah, in the chat. Let's get to those.
So Melissa, I'm gonna need your help. My laptop died, so I'm using my phone. So Melissa, can you help us out with the questions in the chat?
The first one I see here is, do you pay taxes on all the profits in the year the profits are earned?
I could take that one.
Yep.
And yes, I mean, typically, yeah, you're gonna pay taxes in the year you earn it. You know, you gotta do your tax return, pay your taxes. The one thing I would add to that though, obviously we want our businesses to be profitable, but you could also make losses. And depending on the structure, to the extent you have losses, some of those losses can be carried forward if they're not used in the current year to be deducted from future profits. So that's also, you know, from your future tax return, your future income. But yeah, typically, yeah, you got to file your tax returns and pay your taxes in the year the profits are earned.
And
Yeah.
Jason, I was also gonna, I mean, not for today, but just bring up, you know, is it a cash basis accounting, if it's accrual, you know, if you're
Yeah.
amortizing. So there are a lot of other tax devices that can
Mhm.
impact what your actual tax liability will be in a particular year.
Yeah, and that's a good point, you know, as Marva Joe mentioned, you know, whether it's cash basis or accrual basis. For most small business, we typically recommend cash basis, and this is basically where you're just paying the taxes as the cash comes in, you know, as opposed to accrual basis where you'd have to take into account your receivables and you're probably paying taxes on money you've earned, but you've not received the cash as yet. So, you know, that's maybe something for a bigger discussion down the road, but that's a good point as well. Yeah.
Now, about that, I just want to make clear to everyone there, a real simple explanation, accrual and cash basis. Accrual basis just means that you post the sale to your income statement today, because let's say I go out and I sell something and I sell it today, but they're not paying me today. So today is, let's say I sold it on July 31st. So I'm posting it as income for July 31st, but I don't have any cash yet because I'm giving them net 30 payment and they're going to pay me sometime in August. So I get the cash in August, but I post the sale in my income statement in July. That's accrual basis, right? Your cash is coming in later than you're actually posting the sale. That's an administrative complexity that you may not want to deal with in the beginning. So as Jason said, you just do cash basis, right?
Yeah.
I'm going to post the sale when I get the cash. So I'm going to post it in August, not in July when I signed the contract or whatever to deliver the services or deliver the products, you know, when I got the purchase order from my customer, right? That's what that difference refers to. Next question here is, what's a property return?
And Marva,
It's a Maryland. I think it's about $300 now. It's a way for Maryland to get money. I wish I could be more legal in the way that I approach it, but I do think there was some legislation, so I may be a little behind, that was going to do a waiver on the property return. And I will, because I want to give you the most up to date, I will send that out. But that really was something that I was seeing a lot of forfeitures based on people not understanding that liability once they formalize the structure of their business.
Yeah, I've seen that a lot too. Yeah.
Next question here is, if we are 50-50 partners and one is president and getting paid a set salary, does the other need to be paid a salary, or can they just get a monthly distribution, a monthly bonus, she calls it here, but a monthly distribution?
As I said before, it's a contract. You write it in the way you want. And so there's no legal requirement for that. You just want to make sure you're very specific about who's getting what and what the tax and distribution implications are of it.
The next thing is, when you get, it says here, please discuss the difference between a member managed LLC and a manager managed LLC.
I will give you an example that we had. This is a interesting example. I think we had a LLC that was fully owned by an entity. It was a governmental entity. So all profits went to that governmental entity. However, the managers by way of an agreement, made all decisions with respect to the operation of that LLC. So even though that governmental entity was the recipient, they had no right to make any decisions with respect to that. And you can, through your agreement, put that in there so that there's a separation between who owns and who manages. You also may do it with members, but then you designate only one within that structure who would be the manager, and the others are really just recipients of the dollars.
So that agreement is the articles of organization. And this brings up something that you may have heard about. You may have heard this sometimes, maybe in pop culture, a movie, in a TV show, or maybe just talking to people, something, a silent partner. What does that mean? What that's getting at is maybe there's a 3-member LLC, but one of them is a silent partner. That means in the articles of organization, that person has no rights except what Marvin Joe said. I get money. If there's profits, I get profits distributed to me according to whatever it says in the articles of organization. But I have no say in the management. I'm silent. That's what that's referring to. I don't get to choose what our business strategy is. I don't get to choose whether we buy this equipment or that equipment, whether we enter this market or that. I don't get to do nothing. I gave money to get part ownership when we formed the LLC, and I get my distribution of profits according to what it says in the articles of organization. But I don't have any say in the management, in the running of the business or anything like that. That's what that's referring to.
So let me add something to that though. So I typically, whether it's articles of incorporation, articles of organization, I try to make those as broad as possible, because if you change them or need to change them, you have to go back to the state to change them, and that costs money. So I may have a more generalized articles of organization, and then when I actually do the member agreement, is where I will start to do more specificity in those, because I don't have to go back to the state in order. It's the same way I'll tell, and again, Ken hears me ad nauseum about this with nonprofits. You know, we will do the articles broad, and then the bylaw specific, and then even operations even more specific. But what I try not to do is put so much specificity in the articles of organization, even though David's right, enough, but not so much that I would have to go back each time I need to change it, because things change or people change. So.
Yeah. And for that, get advice, right? So what you're trying to do is strike a balance between that flexibility and specificity, so there aren't arguments later. Well, how do you strike that balance? If you've never done this before, you're not going to know how to do it. So you can go to the SBA resource partners, you could go to the SBDC, the Women's Business Center, the SCORE Business Mentors, if you're a veteran, the Veteran Business Outreach Center, or you could go to people at the Maryland Black Chamber of Commerce, and you can talk to some of the business people there, like the Marvin Jones and the Jason Williamses, and you can get advice from them on this kind of stuff. Next question is, what do you recommend, consultant or W-2 for yourself as a discipline? Well, Crystal, I brought it up because of what I see in federal contracting. And in federal contracting, people in the 8A program, we get these they have annual reporting requirements if you're in the 8A program. And every now and then we'll see somebody who starts to have some success, right? They get a few contracts. They're up to 5, 6, 7 million a year in revenue. They still don't have that many employees. They have maybe a few contractors. It depends on the industry they're in, but if you can do this with low amounts of labor, it depends on what you're doing. Now, then they start approaching 10 million in revenue, and somehow 10 million is this round number that feels very, very big. And people start taking a lot of money out of the business, meaning distributing profits to themselves. And we look at their reports, and we have requirements that say you cannot overpay yourself. You can't pay yourself for something that's, because as far as distribute excessive process to you, because you are taking money out of the business that helps the business be sustainable. If the business has no cash left because you've taken everything out and done it to, redo your house or buy a second house or buy 2 cars or buy a boat or whatever, all this. And I'm not making this up. This is stuff that we actually see happen because we get their tax returns because they're in the 8A program. We can see what they're doing with their money, right? If you do all that stuff, you're leaving little money in the business for it to have just a cash cushion in case of an emergency, have liquidity in case they get a new contract and they have to hire people, right? You're harming the potential growth, like as Ken said, the potential growth ability of this business, right? And so we sometimes say, enforce discipline on yourself. Pay yourself this much and everything else is left in the business. Now, if you feel you need that discipline, consultant or W-2 for yourself as discipline, talk to Jason about the tax implications of either of them for yourself, right? What I recommend is that you have the discipline. How you execute that, whether that's not taking too many profit distributions, or paying yourself as a W-2 employee, or paying yourself as a consultant, how you choose it, that's for you to decide. What I'm saying is just have the discipline to leave some profit in the business so it can grow. What
David,
resources? Yes.
I'd like to add something to that as we're talking about W-2s. So again, depending on your structure, I touched on this earlier, but just kind of to expand on it a little bit. If you've elected S corporation status, then you have to pay yourself as a W-2 employee. And the IRS says you got to pay yourself a reasonable salary. Now, that reasonable salary, there's no set number. You have to decide that based on your industry and the level you're at in your organization. So you look at comparable companies doing the same thing at your level, what would they earn? So that's a requirement for an S corporation. And to also, this is kind of a little bit of a different, area, but also in terms of the S corporation status too, that's something I see sometimes a lot of companies come to us and they're S corporation status, but they don't know why they're an S corp and what's the benefits. And typically, if your company one of the benefits of S corporation is it helps you to manage your taxes better and typically to pay less taxes. But that only happens if your company is actually profitable, because what it does, you don't pay self-employment taxes as an S corp, and that's a big chunk of the taxes for like a single member LLC. So if you're profitable as an S corp, then you can forego some of that self-employment taxes. You still got to pay taxes on the W-2, but typically, depending on the level of profits, the gain from not paying that self-employment taxes would offset the income taxes that you would have to pay on the W-2. So just kind of want to put that out there. Maybe in another webinar, we can go into that a little more, but just wanted to kind of throw that out there as well.
Yeah. Things to discuss with either Jason or someone like Jason, or one of the SBDC advisors or SCORE business mentor, somebody who has experience with this, it can tell you what's the best thing for your situation. Now, it says there's a question here from Team Parker. What resources are there to identify professional to support small business? Do you mean resources to identify, do you mean like tax professionals, lawyers, things like that?
Yeah.
Yeah, okay, well, that's what the Maryland Black Chamber is for. Get in touch with the Maryland Black Chamber and find other small businesses that are of that type, right? You find the Marva Joes and you find the Jason Williamses in Maryland who provide these services, and that's how you can get there with them. Now, if you're looking for business advising and business mentors and everything like that, then there's the SBA Resource Partners, so Women's Business Center, Small Business Development Center, Veterans Business Outreach Center, and the SCORE Business Mentors.
And I did want to thank you for that, David, because that's very important. But one of the things that NBCC is committed to is sharing the talents of the membership and really categorizing it so that if you're looking for a financial person, an accountant, a lawyer, we are very big on trying to support each other when we have those skill sets and having opportunities Because sometimes people can have equal qualifications, but sometimes having a network that you get to meet those people. Because I'm sometimes, once I see what you can do, I want to know how we interact and if we're comfortable. And I think, so one of the things we also try to do is networking opportunities. So if you're looking for someone and they have the skill set, you also get opportunities to meet and talk with them and see what you think.
And the last one here is, can you restate what you mean by billing in 1 year? In other words, December, getting paid in the following year. Do we book the money and pay taxes in January?
I'm sorry for breaking up accrual. Go ahead.
No, let's go. So all that refers to, Sharon, is booking. What I meant by booking is where you record it in your income statement. You book it in the income statement, right? In July, because the purchase order was signed, it was made in July. But they don't pay you until August, maybe August 15th. So you get the cash August 15th. That's when the automatic transfer comes through, or when the check clears, or whatever. You got the cash in your account August 15th, but you made the sale July 30th. You book it, meaning you put it, that's my word for my expression for just entering it into the income statement and on a ledger, you put it in there. And then in your when you're doing your taxes, when you're analyzing at the end of the year your financial performance, another word for income statement is profit and loss statement, right? So when you're looking at profits and or losses at the end of the year, you're gonna know, okay, the sale was made here, but I'm on an accrual basis. The cash was received in August, but the sale was made here. And this is part of a broader thing, a bigger thing of analyzing the performance of your businesses, because you might notice in your business, wow, we book a lot of stuff in June and we don't get paid until July. Why? Maybe that's the nature of their business. Maybe, I don't know, what do you sell? Maybe you sell beach balls. Okay, so you sell beach balls, you book a lot of business. You're selling beach balls to retailers. Retailers are giving you purchase orders for a whole lot of beach balls, say in May, a whole lot of them, and they're paying you in June. Okay, this is part of your business analysis.
Last fall, we did a financial series, and what Jason, we did like October, November, December, making sure that folks are ready for tax income. So we'll do that again. I want to simplify what David and Marvin and Jason have said. Most businesses, you will do your internal financials on a accrual basis, because you want to know exactly what money you earned, what money you're owed, and you want to know where you stand. But what Jason is saying, at the end of the year, most people would say, let's do our tax return on a cash basis. Who wants to pay taxes on money I don't have yet?
Right.
So just keep it that simple.
Yeah.
And then we'll have some more webinars to talk about understanding financial statements and so on and so forth. But basically, at the end of the year, when you do your taxes, you want to do taxes based on accrual. Accrual sometimes makes you look better.
Yeah, it makes.
But cash it limits your tax liability.
No, it may make you look bad. Cash makes you feel better.
Yeah.
So,
Exactly.
That's what Sharon was talking about. She was talking about an example of December and January.
Yeah.
Okay, so Sharon, we know what you're getting at, and what we're saying is there's a whole other webinar for that. we could get all in the weeds in that at a different one here. But we know what you're getting at, and it's good that you're thinking about it, right? That's already a good sign. So, all right, so we've covered organizational types. Really, it's about telling you that these other ones exist, and the best thing for you is going to be an LLC when you're just getting started. If the universe spits puppies and rainbows on you, and you turn into a giant business, and eventually you become a corporation, great. By that time, you'll be able to afford 10 Marvin Joes to get you your articles of incorporation done the right way. Right? But for right now, don't worry about it. LLC is the way to go. And I have this, I've been sharing this thing from the Maryland website, Maryland Business Express, egov.maryland.gov. Registrations and filings is where you find this. It's got information about filing types, new business filings. This is where you would do it. trade names, this has got some information on this. And then on the on registering your business, over here, there's the fee schedule. And here, if you want to do a limited liability company articles of organization, the base filing fee is $100. If you want to do rush processing, I don't know why you would do that. $325, expedited processing, $50. There you go. So it's $100 to base filing fee. If you're going to do articles of incorporation for a stock corporation, it's not even that much more. It's 120. The complexity is not in this. It's not in this money. The complexity is in the articles of incorporation and all the legal stuff that goes into it, right? But I just wanted to show you, this is where you can get this information on this, and this is where you can do it. Filings to change or amend an existing business. This is changes the articles of organization that Marva Joe was talking about that you don't want to be doing. So before you do it in the first place, go get some advice, go get some counseling, go get some mentoring on what's the right balance of specificity and generality you want, so that you don't have to go do one of these amendments, you know, every year and a half or something like that when something in the business changes. But anyway,
I want to clarify something here. So I'm recognizing some of the folks here in attendance. So your recommendation, it really applies, I think, to those who are just starting their business.
Yes.
There are some seasoned business owners on this call.
Oh, okay.
So there are some that have been in business. You know, I know Steve's on here. He's been in business for like 27 years. So, so I just want to, you know, I think the recommendation is, if you're just starting out and you're a one-man operation, that may be the most favorable way to go. But all cases are different. So you definitely want to talk with your accountant and your attorney to see what's best in your particular situation.
Yeah. This is really for people just getting started. What am I going to do?
Right.
All right. Hey, so we got every question answered here, and you know, knock
Very
yourself out. Everybody go get the resources, and good luck and everything. What, any last words, Marvin, Joe, and Jason?
Yeah, I mean, I would just reiterate, you know, keep it simple, stupid. Start with an LLC, you know, as the business grows, you get a little bigger, you might want to think about S Corp, you know, if you're profitable and you want to manage your taxes a little better, you know, so you're profitable, you feel like you're growing, you want to have a structure in terms of paying yourself wages. We can talk about an S Corp, but as you mentioned, the C Corp, you know, that's for really the bigger corporation. So let's just keep it at the LLC. You get the right protections and you can manage things better from a tax standpoint, you know, for a small business. So that would be my, you know, kind of closing.
Can I ask Marva, before you speak, so I don't want everyone to sign off before, can you, Marva, and Jason put your contact information in the chat so that folks, if they want to circle back to you and have more detailed conversations, they can reach you if they like to.
I wanted to echo the comment about the structure, because LLCs were really in response to trying to have some simplicity with protection. So it kind of mirrors the sole, it tries to merge the sole proprietorship with the corporation. So that's why it was actually created. But what I wanted to kind of end with, and we had a meeting this morning, an NBCC meeting, and one of the things we talked about is that if you don't have a strong foundation, the rest of it can just crumble. And so I know people want to go quick a lot of times, but spend the time doing the research, spend like doing today what you did, and spend the time making sure you've asked those questions so that you've got your structure in place, and so that then you can move about the rest of what you're trying to do to make your business successful. But I see too often not enough time spent on sort of that, what I call back office, and it comes to haunt later on. And then they have to pay more to attorneys, which we don't mind, but I would not want, or accountants, we would not want you to have to do that.
Yeah.
Melissa, can you also put the NBCC contact info in the chat? And with that said, I want to thank David and Marva, Joe, and Jason. This was really valuable information. You guys took what was like a C-level outline and really did an A+ presentation. So
Right.
I want to thank you for that. Thank you, Marvin, Joe, and Jason, for agreeing to kind of come in and kind of add some support to what David and I present on a monthly basis. So this is greatly appreciated. And
Well, thank you, Ken, and thank you, David, for allowing us and
Yeah.
also including us and asking the questions as you went along. It was much appreciated.
No,
Yeah.
I'm happy to have SMEs, subject matter experts on this. It's great. Because I know you all have stories. I know the learning comes from the stories. I mean, because otherwise we're just talking textbooks, which are
Mhm.
textbooks are different.
And so David took y'all to a whole new level. He was giving y'all like the PhD question.
Yeah.
I was getting scared, David. I was like, wait a minute.
Yeah.
I'm glad that they really know what they're talking about, because David's putting it on them.
You didn't see me stopping there for a second and really thinking before I started talking, Ken, because he had me going deep.
I'm good about.
Oh, indeed. Well, wait a minute, Jason. I was getting ready to go off camera because I was like, woof.
Go do a little research by the side.
Well, thanks again, everyone. If no one has any further questions, thank you again. Thank you to all of you guys for supporting us and showing up to our webinars and making our series a success. And we look forward to seeing you next time.
All right.
Thank you all. Good to be a part of it. Bye.
Bye.